Ever feel like your business is paying more tax than it should? Meanwhile, you read that Amazon made $1 kajillion last year and somehow paid less tax than your local coffee shop. Yeah, you're not imagining things. Today, we are pulling back the curtain on how global giants like Amazon, Google and Apple use something called transfer pricing to legally shrink their tax bills. But here is the twist. This isn't just a big guy's game. If you run a business that crosses borders, even just like a Spanish parent company with a Czech or German branch, this affects you too. So grab a coffee, maybe a spreadsheet, and let's talk tax strategy without the headache. Let's break this down in plain English. Transfer pricing is basically the set of rules and methods companies use to decide the prices for transactions that happen between different parts of the same business, usually across different countries. It's kind of sound weird, right? Like, how can you sell something to yourself? But if your business owns a subsidiary abroad, let's say your main company is in Poland and you've got a branch or sister company in Germany, then anytime you move something between those entities, whether it's a product or a piece of software, a management service, or even a trademark, you need to set a price for it, right? And that price isn't random, or at least shouldn't. It has real consequences. Why? Because it determines where the profit is booked and, more importantly, where it gets taxed. If the profit shows up in a high-tax country, like your overall tax bill will naturally also be higher. If it lands in a low-tax country, your business suddenly becomes a lot more efficient without changing anything operationally. Now, here is where it gets really interesting. Let's say Country A has a corporate tax rate of 30% and Country B taxes at just 5%. If you have flexibility in how you allocate profits across those two jurisdictions, guess where you want that profit to end up, right? Exactly. It's like a game of tax Tetris. Fit the pieces in the right places and everything will flow beautifully. That's what transfer pricing enables. It gives multinational companies, big and small, a legal, rule-based framework to shift profits to jurisdictions where tax rates are lower, without moving a single box, person or office. And when you do it right, it's not about dodging taxes. It's about not overpaying it. You get to keep more of what you earn, reinvest in your business, grow faster, and not hand over an oversized slice of your profits to the tax office with a sad little bow on it. But because let's be honest, you already take the risks, you already put in the work. You should at least optimize the rewards. Oh, and quick intro, if we haven't met. I'm Michael. I'm a lawyer and economist with over 10 years of experience in transfer pricing and business analysis. I run a company called PREZO. Links down below if you want to check it out. We help growing businesses like startups, manufacturers, e-commerce brand get serious about their numbers. That means transfer pricing, financial strategy, and building smart legal systems that actually works across borders. Each year we work with 100 plus companies. And honestly, it's always the same challenge. You are not just looking for simple advice. You want clarity, actionable insights, and a way to grow without losing half of your profit to taxes. That's what this channel is here for, and that's what we do at PREZO. Let's dive in. Alright, let's talk Apple. Now, when people think about how Apple makes its money, they usually picture shiny phones flying off the shelves or long lines outside Apple stores every time a new model drops. And yeah, that's definitely part of it. Apple sells a ton of hardware, but here's the thing. Hardware isn't where real magic happens. The real gold mine, it's the IP, the intellectual property. That's the software, the sleek product design, the user interface, the ecosystem, the Apple logo itself. All of that enormous value. You're not just buying a phone, you're buying into the experience. And Apple figured out how to turn that IP into a tax-cutting machine. Here is what they did. They said, let's move the rights to our most valuable assets, our IP, into company based in Ireland. Why Ireland? Because at that time, Ireland was basically the Las Vegas of global tax planning. Low rates, friendly rules, and no questions asked if your structure look a bit, creative. So Apple sets up an Irish company to own the rights to its software and trademark outside the US. Then every Apple entity around the world, like Apple in Germany, Apple Japan, Apple Poland, had to pay royalties to the Irish company for using that IP. That's standard transfer pricing, charge for the use of your assets. So every time someone bought an iPhone in Paris or Tokyo or Warsaw, a chunk of the profit flew straight back to Ireland, on paper at least. Think of it like this. Profit weren't staying in the country where the sale happened. They were being vacuumed up into Ireland, smoothly, quietly, and very efficiently. And here's the kicker. At the time, there was a loophole in Irish tax law that allowed a company to be incorporated in Ireland, but not to be tax resident anywhere. So no tax residency means no tax. So Apple's Irish company was in this weird tax limbo. It was registered in Ireland but didn't pay tax there, or anywhere else for the matter. The result? In 1 year, Apple had an effective tax rate of 0.005%. Let me say that again. 0.005%. And that's like someone asking you how much tax you paid last year and you are saying, oh, I think I covered it with a bus ticket. Meanwhile, your small business is out here scrapping together cash for advanced tax payments. Eventually, the European Commission said, okay, come on, that's not right. They accused Apple of getting illegal state aid and slapped them with a 13 billion euro back tax bill. Now, here's the twist. Ireland didn't want the money. They actually teamed up with Apple and appealed the decision. Why? Because Apple had created thousands of jobs, pumped money into the local economy. They basically turned Cork into a tech hub. Kicking them out would be like firing your best employee for working too hard. But after years of legal back and forth, the EU finally got the last word. In late 2024, the European Court of Justice ruled against Apple. Game over. They'll have to pay the full 13 billion euro. So yeah, Apple's structure was clever. It worked for a long time, but even the smartest tax play eventually runs out. Next up, Google. Now, Google's tax play was so legendary, so delightfully complex, that it actually got a nickname. Not something boring like IP structure number 47B. No, they called it Double Irish with a Dutch sandwich. Sounds like something you would order at the European brunch spot, right? Hi, I have a double Irish with a Dutch sandwich, hold the VAT. But no, this wasn't about food. There was no bread, no Gouda. Just billions of dollars quietly sliding through the loopholes. Here is how the recipe worked. First, Google's Irish subsidiary, which handled advertising for Europe, the Middle East, Africa, collected the bulk of the non-US ad revenue. That's billions with a B. But instead of sending royalty payments straight to a tax haven like Bermuda, they made a pit stop in the Netherlands. Why? Because under EU law, royalty payment between EU countries generally aren't hit with the withholding tax. So that middle step, sending cash to a Dutch entity, meant less friction and a fewer tax bites. Then from the Netherlands, the money flowed to a second Irish company. Except this one was tax resident in Bermuda. So the route looked like that. Ireland to Netherlands to Ireland. But the last one with Bermudian for tax purposes. And that, my friend, is the Dutch sandwich part. To recap, no bread, no cheese, just a beautifully crafted cash tunnel optimized for tax savings. And this wasn't some niche little hack. This structure helped Google funnel over $20 billion per year into zero tax jurisdictions. Let me repeat that, $20 billion per year. That's enough to fund like a small country or buy X and still have change for snacks. And the best part for Google, it worked like a charm. For more than a decade, this setup quietly shaved billions of their global tax bill, all while operating inside boundaries of what was technically legal. Eventually, though, the music stopped. Under mounting pressure from tax authorities, public outrage, and a lot of headlines that includes phrases like moral responsibility, Google started phasing out the structure in 2020. But let's be real. By the time they shut it down, they already saved enough to build a few extra moon bases. Or maybe even launch their own island nation where the only law was like JavaScript and the only currency is ad clicks. The structure's gone now, but the legend lives on. Now let's talk Amazon. Their setup, a little less flashy than Google's sandwich trick, no fancy names, no tax cuisine. Amazon skipped the Delhi metaphor and went for something simpler. Luxembourg. You know, the tiny country with more holding companies than people. Here's how the play worked. Let's say you are sitting in Berlin or Paris, scrolling Amazon for a Bluetooth speaker, a baby stroller, maybe a third pair of noise-cancelling headphones because your toddler has discovered drum solos. You click Buy Now on Amazon.de or Amazon FR, but here's the twist. You are not actually buying from Germany or France. The transaction is routed through a company called Amazon EU SAR based in, Luxembourg. So the sale is booked in Luxembourg, not the country where the customer lives. Now, Amazon EU SAR did book the revenue, sure, but the profit? That's a different story. Most of that profit didn't stick around because Amazon EU turned right around and paid hefty royalties to another Amazon entity that held the rights to its technology, logistics system, and trademarks. Basically all the secret sauce that makes Amazon Amazon. And that entity also in a favorable tax jurisdiction. So once again, the money goes in at the front door, then quietly exits through the side alley, destination low-tax land. It's like a spy movie, but instead of briefcases and codes, it's just digital transactions and IP licenses. The result? Amazon booked billions in sales across Europe, Germany, France, Italy, Spain, but little of the profit ever stayed in those countries. It all flowed through Luxembourg and from there to places where the tax bill was basically a rounding error. And for a while, that worked just fine. But then, the European Commission came knocking. After digging into details, they decided Amazon's arrangement wasn't just aggressive, it was a little too cozy. They called it illegal state aid. Translation? Luxembourg gave Amazon a sweetheart deal that gave them unfair advantage over the companies. Especially say a mid-sized e-commerce company in Belgium trying to compete and pay full tax like a good citizen. So, in 2017, the EU told Amazon to pay back 250 million euros in unpaid taxes. Amazon, in true megacorp fashion, basically said, not sure, we agree, but thanks for your opinion. Luxembourg just kind of blinked, maybe checked the weather and also moved on. Because here's the thing, when you are Amazon-sized, even your tax disputes have sequels. You don't just get a fine, you get a mini-series, maybe even a documentary deal. And while 250 million euros sounds like a huge amount for a company generating over $100 billion a quarter, that's like finding a coin in the couch cushions. The real story here isn't just, Amazon optimized its tax. It's how quietly and effectively it did it, using a jurisdiction that most people wouldn't even think about when buying a coffee machine online. Now, let's hit pause for a second, because I know exactly what some of you are thinking right now. Hold on, this sounds like kind of shady. Is this stuff even legal? It's a fair question. And the answer is, yeah, mostly. These big multinationals aren't just rolling dice and hoping for the best. They are working within the rules, just very, very creatively. At the heart of all of this is something called the arm's length principle. If you never heard of it, here's like the basic idea. When two companies are under the same umbrella, like a parent and its subsidiary, they are supposed to pretend they are strangers when they do business with each other, as if they are like total outsiders negotiating a deal at arm's length. So, if Google Ireland pays Google Bermuda for using some tech, they are supposed to charge the same royalty that Google Ireland would pay if they were licensing it from a completely unrelated company. It sounds reasonable in theory, right? But in practice, it's messy. Because here's the thing. How do you actually price something like a cutting-edge algorithm, or the value of Apple logo, or the entire like Android operating system? There is no online marketplace where these things are traded. No eBay listing that says buy Google's search ranking tech, lightly use. No Fiverr freelancer offering complete mobile OS plus brand loyalty package delivered in 48 hours. So companies have to estimate the value. They create models. They run comparables using data from somewhat similar transactions. And they put together very official-looking documentation to justify the numbers. That's where the gray zone actually starts. Because if you give 10 tax experts the same piece of IP to value, you will get 10 different answers, and all of them will sound pretty reasonable. Now, imagine you are Google or Amazon or Apple. You've got entire tax departments. You've got legal teams, economists, Big Four advisors, and war rooms like full of whiteboards and coffee. You've got resources. So when it comes to defend your pricing, you are not showing up with a napkin and a calculator. You're walking in with a 100-page report, charts, economic analysis, and 3 consultants named Jonathan. And let's be honest, when you've got that kind of like firepower, it's amazing what you can do, what you can make look arm's length. It's not illegal, just very well packaged. Eventually, the world's governments look around and said, all right, that's enough of this nonsense. All these multinationals shifting profits like they're paying 3-card Monte with a tax return, it couldn't go forever. Enter the OECD, a group of mostly wealthy countries who, among other things, try to set international standards for tax. And in 2013, they dropped the big one, the BEPS project. That's short for base erosion and profit shifting, which sounds like something out of geology textbook, but it's really just tax speak for, hey, stop moving profits out of our country. BEPS was a global plan to clamp down on aggressive tax avoidance and bring more fairness and transparency to the system. And with it came a whole new wave of tax rules that made accountants like break out in a cold sweat. Here is what they rolled out. Mandatory country-by-country reporting, so multinationals have to show where they earn their money, where they have assets and employees, and where they actually pay tax. Spoiler, those 3 weren't always aligned. Tougher rules around intellectual property, especially to make sure profits linked to IP weren't magically landing in tax havens that had 0 engineers and 0 laptops. Economic substance laws, which basically said, hey, if you want to enjoy low taxes in, say, Bermuda or British Virgin Islands, you actually need to have a real business there, not just a mailbox and a palm tree. And then came the big one, the rule that really got headlines, the global minimum tax, set at 15%. The idea is simple. If a company books profits in a country with super low or no corporate tax, the home country can now step in and say, cool story, we are topping it up, you owe us the difference. So if Google pays 3% in some jurisdiction and the global minimum is 15%, then the country where Google parent company lives can charge extra 12%. Boom. No more free rides like in the Caribbean. In theory, it's a game changer. It makes profit shifting less attractive, levels the playing field, and gives tax authorities a new tool to fight aggressive planning. But in practice, well, it's complicated. Implementation is slow. Different countries are adopting the rules at different times in different ways. And surprise, surprise, the biggest companies still have more tax experts, lobbyists, and lawyers than most governments have auditors. So, yeah, the rules are changing. But it's like, watching a glacier move. Technically progress, but you're gonna need a lot of coffee. So, the direction is clear. The Wild West of global tax planning is slowly being fenced in. And if you're running a business, even a small one, that sells across borders, it's worth keeping an eye on where this is all going. Okay, let's be real. You are not Apple. You are probably not routing billions in royalties to Bermuda while sipping espresso in a glass-walled office in Luxembourg. You've got more practical things to worry about on a daily basis, like sales, payroll, invoices, maybe finding a decent accountant who actually returns emails. But if your business is working across borders, even in a small way, transfer pricing still applies to you. And that surprises a lot of people, because here is what most business owners assume. Transfer pricing? Oh, no, that's only for the big fish. We are not global enough. But actually, if your company checks any of these boxes, like you have clients in more than one country, you've got subsidiaries abroad, or even just one related company in a different jurisdiction, like you provide services, software, even branding support across borders within your own group, then congratulations. You're officially in the transfer pricing territory. Now, don't panic. It's not about drowning now in paperwork or hiring a tax army. It's about being smart with how to structure things. Because here is the part that most business owners completely miss. Transfer pricing isn't just a compliance headache. It's also a powerful tool for cash flow management, like tax optimization. Let me give you an example. Let's say you've got your main office in Poland, your headquarters, leadership team, finance folks, and then you've got a small operational unit in, say, Czech Republic. They are doing sales, customer support, maybe fulfillment. Well, your Polish headquarters probably provides some value to that Czech subsidiary, like management support maybe, strategic direction, admin services, maybe even R&D. And guess what? You can charge for that. Not made-up fees. No, but a reasonable transfer price that reflects the real value of those services. And that lets you shift some profit back to Poland or wherever it makes the most business sense, as long as you can justify it. Because that's the catch. You've got to back it up with clear internal records, benchmarks showing that your pricing makes sense compared to what unrelated parties would do. And ideally, a transfer pricing policy that wasn't written on a napkin in 5 minutes before an audit. This isn't about trickery. It's about documenting what's already true and making sure you're not leaving money on table just because your accountant never mentioned it. And here is the best part. If you are doing this right, if you want to do this right, you don't need a Big Four firm or some international tax wizard in a skyscraper. What you need is good planning, a clear understanding of the rules, and someone who actually knows how to apply them to growing businesses. Maybe your newly recognized YouTube host right here. So, seriously though, transfer pricing isn't just a legal requirement. It's a strategic opportunity. And when you run a growing business, those little optimizations, they add up fast. You will notice that. Look, transfer pricing can sound like a corporate wizardry, and to be fair, in some cases, it kind of is. The way some multinational structure that thinks it's like watching financial chess at 5D speed and with lawyers, economists, and tax advisors all playing on different boards. But here's the thing most people don't realize. You don't have to be Amazon or Apple to use transfer pricing. This isn't just a mega corporation secret club. These tools, the same core strategies, are being used every day by smart, growing small and medium-sized businesses. Businesses like yours. So, next time you stare at your tax bill and think, why does it feel like I'm being punished for expanding? Or, why am I working harder and keeping less? Just remember, you've got options. You don't have to game the system. You just need to understand the rules and use them like the pros do. And hey, if this video helped you make a lot of this a little less scary, a little less foggy, go ahead and hit that thumbs up. It tells the algorithm that this kind of content matters and helps more business owners like you to find it. If you want more deep dives like this, subscribe to the channel. I would really appreciate that. We talk transfer pricing, international tax strategy, and all of the stuff that no one ever taught you in the business school, but absolutely should have. And hey, I'd love to hear from you. Drop a comment below. What's your biggest frustration when it comes to international tax rules? Is it documentation, cross-border payments, dealing with accountants who somehow ghost you? Tell me, I read every single one. And who knows, your question might inspire my next video. I'm Michael and this is what I do. Thanks for being here, thanks for caring about your business, and I'll see you in the next one.